Today we have a very special guest. It's like talking with the king of real estate. So we have we have Brian Burke. Brian, thank you for joining us today.
Thanks for having me. I appreciate it.
Sure. Brian, tell us a little bit more regarding your background. How did you get into real estate?
Well, I kind of got into this on a whim. When I was 20 years old, I was trying to figure out a way to make money. And real estate looked like a really interesting way to do it. So not really knowing anything about real estate or having any contacts in the industry and not even having any money, it was a pretty steep hill to climb.
All set.
Yes, I was all set. I had everything I needed. So I thought, why not give this a shot? And I'm really glad I did because I absolutely love this business and couldn't imagine doing anything else.
But how did you start? Coming from just a dream, because everybody has dreams, but what's the plan? So how did you went about and actually started doing something?
Yeah, that's a great question and a very true statement as well. So, for me, I started out, I bought a small rental house here in California and rented it out. It was my first experience with real estate, and it wasn't a good one. Like most people that are getting started, you don't know what you're doing yet, so you're trying out new things, and you're trying to see what works. And that's what I was doing. I was trying to see what works. So I rented it out, and a couple years later sold it. I think if I'm lucky, I broke even on it, but that was enough to get me hooked.
But if you didn't have any money, and I think this brings a lot of value to young entrepreneurs, how did you went about and buy something that you didn't have any money, nor experience, nor just only besides the wheel?
Yeah, that's a great question. I was working as a grocery clerk at the time. I was making about $12 an hour part-time, and I had somehow, I guess, just enough income to qualify for a loan on the property. It was only, it was around $100,000. I mean, it wasn't a very expensive property. This was 1989, so that got you a little bit more in California than it does now. Just a little bit more. And so I got the loan, and I didn't have the down payment. So I convinced the seller to carry back the down payment, and they agreed to do that. It was kind of amazing that they actually agreed to do that, but they did. Came out okay for them. I guess that was also my first experience using other people's money to buy real estate. And so I basically came into the deal with no money down. And kind of left with no money either, so that kind of worked out.
But for people that don't know what carryback is, can you explain this a little bit?
Yeah, so essentially the seller of the property, instead of me putting up a down payment to bridge the gap between the amount of the loan price, the seller instead agreed to carry a loan for me for the amount of the down payment. And then I would make, in addition to making payments to my lender, I would make monthly payments to the seller of the property. And then when we sold, the lender and the seller, both loans were paid off through the proceeds of the sale.
What was the holding period?
I think it was about 2 years, give or take. It wasn't very long.
Okay, so you basically ended exactly like you started. The only difference is a little bit your first deal, right?
Yeah, a little bit of experience. It's like I went in with nothing and came out with nothing, but I learned a lot. And to me, knowledge is very valuable. More valuable than capital in some respects. And so it enabled me to take my real estate investment career to the next level.
And what was the next level? How did you what was the next for you? So you figured out, okay, I broke even on this deal. How does one come about and start from that one and having like 700 plus deals that like you have today? What went after that one?
Yeah, so the next one was a simple single family house flip where there was a house that was in foreclosure. It was in disrepair. I think we found it just looking at foreclosure listings and sent a postcard to the owner, who called and said, I need to get out of this house. And so we bought the house for $1,500 plus they would sign over the deed. and we basically bought it subject to the existing financing. From there, I borrowed money off my credit cards to pay off the back payments on the foreclosing loan and to keep that loan current while we fixed the house up and resold it, which we did just a few months later. Made a few bucks, lender got paid off, and that one actually worked out pretty good. And another experience builder for me.
And how from that deal, how do you went about and kept building your career? Did you have a steady job? Did you just doing this? It was on a side? How was it?
Yeah, so by this time I was now working law enforcement, and the beauty of that job was, I was working swing shift, which was 4 p.m. to 2 a.m. and I had Monday, Tuesday, Wednesday off. So I had essentially the whole business week. I had Monday, Tuesday, Wednesday completely free. Thursday and Friday, I didn't have to be at work until 4 o'clock in the afternoon. So it enabled me to run my real estate business while still working a full-time job and making an income to pay my bills. And that's what got me through that early time when, I was doing, a deal every couple of years. And then finally I was doing a deal, a couple deals a year. And then it got to the point where I was doing a couple dozen deals a year.
But you were a one man show, or did you have a partner?
Yeah, I had a partner, and who was a friend of mine initially. Anyway, early on, I had a partner, and basically, his job was to kind of oversee the contractors and to have somebody that looked older than me, because I was, in my early 20s and I looked like I was in my mid-teens. Okay. So I needed to have somebody that gave us a little bit of credibility. And, that was also part of it. It's like, you're 10 years older than I am, and, people will listen to you and they won't listen to me. So.
But did you know what he was doing, or it was just older? That was the only asset that you had?
Well, he had that, and he also had the ability to to tell contractors when to be there and to make sure they did their job. So okay. he definitely brought that to the table, which was nice. And he didn't have a particular construction background, but just the ability to kind of keep people in line, which nobody's going to listen to somebody that looks like a young kid.
and from that, how did you went about and started your first fund?
I started my first fund when I left my law enforcement job. By this point, I was using just signature lines of credit and credit cards, and however I could find money for deals. I built it up to a point where I was doing about a dozen or so deals a year, and then I put in my notice at the police station, and I said, "Guys, I'm leaving in 2 weeks, and by the way, I rented out the room at the community center. I want all of you guys to come down. And I'm going to tell you what I'm doing in real estate and see if you guys want to be involved in some way." So I did that. A bunch of guys from the station came down, and I talked about real estate and values and flipping and finance and all these kinds of things. And I walked out of that room with $500,000 in capital commitments from 28 investors with guns.
You better get them the preferred return, or else.
Or else. That's right. My life was on the line. I knew that there was absolutely no way I could fail. One thing I could absolutely not do is lose people's money, or I'd pay the ultimate price. And from somebody who knows how to get away with it, by the way.
Sure. And what year was this?
This was around 2001.
So at this time, how was the deal flow and the cap rates of the types of deals that you were looking for?
So cap rate, I didn't even know what cap rate was at the time. I was just buying houses to fix up and resell. So I started out just doing that. And in that first fund, I started buying houses at the courthouse steps. Well, I was already doing that before the fund, just on a very limited basis. But now we had the capital to go to the courthouse steps, actually make a difference there, and buy quite a few houses. We're doing a couple dozen houses a year. We did that throughout, kind of the 2000 through, 2007 period. Slowed up quite a bit in 04, 05 because the market was ridiculous here. Made no sense to buy anything, so we really didn't. And then it was 2009, after the market collapsed, that we really started to grow. And at that point, we started, deal flow really got robust. We went from a couple dozen deals a year through the early 2000s through now. By 2009, we were buying, fixing, and reselling over 100 houses a year. in California, which is a lot of dollar volume, and we just grew it from there.
But you, at this time, you weren't doing any multifamily deals, right? It was just a fixer-uppers.
It was mostly that, yeah. I did have a couple multifamilies that I bought personally. That was my introduction to multifamily. Started in 2002. I bought my first multifamily property. It was here in California. I bought my second one, and I think it was around 2006 in New York. And I cut my teeth on small multifamily deals, and then grew it to larger ones in 2008.
And these deals, when you got the capital, it was your thought process to get immediately a team, or you just continued to have your side partner and you were able to get everything done by yourself?
Yeah, by now I had a team. When we grew in 08, we were doing 100 houses a year. By now I had a team. We had 25 employees. I had 2 partners. We had a robust office staff that did a lot of the administrative work. We had a construction team. So we had a really robust team by then. And so getting into multifamily is pretty easy for us because, we already had a lot of infrastructure here. And then our next challenge was to build that infrastructure in the markets where we were going to invest. We first chose Texas as our first market and started investing in Texas. And so, now we had to build a whole team in Texas. We needed property management, we needed finance, we needed insurance, all of those components of the team we had to build from scratch in Texas.
And when 07, 08 came about, you had an haircut, for lack of a better word, right?
We had what?
A haircut.
Oh, a haircut. Yeah. Yeah. Who didn't? Yeah. 2006 and 7 were painful on a personal level. It was funny because I had a lot of investments with investors in it through, our single family business, our house flips and whatnot. They didn't feel the pain at all. In fact, those funds did better through that period than anything else because it was a distressed asset type fund. And, since we were always flipping, we were in and out of stuff so quickly that even though the market was falling, it wasn't very impactful. But, of course I made, all the profits that I made in real estate, I took that and invested it in my own investments, which were longer term, hold type investments. And certainly, our values took a 50% haircut in California during that time. And it was not fun to see that, on that side of the business. But on the other hand, we were doing so well on the investor side that it made up for the, what we took on the personal side.
But for when we feel pain, we tend to adapt and evolve. So what was the shift for you? What was the change that you saw and say, we have to start doing things differently and have to adjust in order to do whatever in order for us to survive and keep prospering?
Yeah, so there's a couple things. On one hand, I knew that there was one way to recover from a downturn, and that's to grow. So we opted to grow, and we went from 2 employees in 2006 and doing 4 or 5 deals a year to 25 employees and over 100 deals a year in 2008. So I knew we had to grow our way out of it. Was one aspect. The other was that I learned the power of an adverse economy. And we bought a multifamily deal in 2008. And it was we bought it for half of what the last guy paid. So by all measures, you would think that we got a killer deal, and we were geniuses because we paid half of what the last guy paid. But the reality of it is when about 6 months after we'd executed the business plan and got the property up to 100% occupancy, is when the great financial collapse in the U.S. Was in complete meltdown mode. That's when Bear Stearns collapsed and Lehman Brothers collapsed, and all that took place, and people were losing jobs, and people were doubling up with family to find places to live, and that was a real impact on a multifamily deal that we bought in Texas. And it turned out that about a year after we bought it, the occupancy fell so low as a result of all these economic problems that there was just enough income to pay for the property's operating expenses, but no money left over for the debt service. So, we were kind of faced with options of, what do you do? Do you hand the keys back to the bank and the investors lose their money? How do you get out of that situation? Fortunately, we had an option, and that was that, by now our flipping business was doing so well that I was able to actually take money out of my own pocket to service the debt on that deal. And so, for about 3.5 years, I was writing checks of over $15,000 a month to keep that deal afloat. And we did. And at the end of the day, we finally sold that deal. Investors got all their money back plus a return. I got all the money I loaned to the company back to float the debt service. And I came out of it with a great lesson that you cannot underestimate power of an adverse economic cycle, and you can't underestimate the importance of economic vacancy factors that's more than physical. I mean, there's bad debt, there's concessions, all those components of economic vacancy on an income property that you really have to account for. And I learned a lot of lessons through that process.
But has your underwriting changed from then to now? Let's say both of us are sitting and we have a deal across the table. What do you look for in a multifamily deal? What is the underwriting fundamentals that you're looking in order to have the deal to make sense for you?
Yeah, my underwriting style has absolutely changed as a result of that deal. We took all the lessons learned through going through that adverse cycle and completely renovated our approach to income property investing, all the way down to developing our own in-house, very sophisticated underwriting tools that we use to model future income. So, now we do a number of things. One is, we employ a number of different economic vacancy components into our analysis. We stress test all of our deals on a three-pronged test. We look at every deal's future income and future exit on a 10-year hold, a 5-year hold, and a 3-year hold. And the fundamentals or the economics have to pass the test in all three of those different measures for us to move forward on a property. And what we want to know is can we deliver to our investors a really good return in 3 years if we execute this business plan? And can we do it if we have to hold it for 5 years? And most importantly to me, what happens if an adverse economic cycle materializes at some point during this 3 to 5 year business plan? What will it look like then? And can we ride that out for a 10-year hold and still produce a satisfactory return to our investors in the mid-teen, low to mid-teens over a 10-year period? And if we can pass all three of those tests, that's when we know we found the right deal.
But do you change the debt service in order to have it like super on the red to see if the deal still makes sense with a high debt level, or do you change this? How's the debt service coverage ratio look on the high stress test of the deal that you guys are analyzing?
Yes, absolutely. So when we're underwriting the debt service, in our model, we have the ability to model our debt service on the fly. So we can change debt service assumptions instantly in our model and see how it impacts throughout the entire 10-year, 3-year, or 5-year hold period. So what we do is we start with just a simple kind of 10-year fixed model, right? And see what does it look like, using that model. Then we model it with 7-year floating rate debt, which is actually our preferred debt structure because it allows us to exit in 2 or 3 years or 5 years without any really heavy or onerous yield maintenance or prepayment penalties. So we test the debt using a floating rate debt along with a yield curve that, where we're able to we have a projection on where rates are going to go over the next 10 years. We add some cushion to that, and that's how we model our debt as we go forward. We also look at refinance scenarios, at multiple points along the hold continuum to find where there's opportunities for us to take cash out on a refinance if we opt to hold for longer periods. And we also are able to model in preferred equity structures and other layers into the capital stack. So one of the things that we look at when we're underwriting on our debt is we want to have a modest leverage. We don't want to be over levered, because that's how people got hurt at the downturn. So a typical property for us, we may come in at 75% of value on the purchase, but by year 2 or 3, we're at 55 or 60% LTV, because we've raised the value of the property. We're looking for debt service coverage ratios kind of in that 1.5 to 1.7 range. If we get higher than that, that's great. And we're looking at different models as to how long that debt's going to mature and what type of rate we're going to use.
But you do have since you are operating in the value add scenario, right?
That's right. Yeah.
So you are looking for opportunities to increase NOI, and one of them is having a lot of other sources of revenue, so laundries and so forth. Do you think, because most properties that we look for are kind of the usually mom and pop stores, and you have to have systems in place, and you already have that. So is there anything else besides that looks attractive when you look at a value add deal?
Yeah, so we're looking at, we want to see a lot of things that kind of spell a perfect deal for us. Okay. We will do really well on a property where it's been owned by kind of a mom and pop operator or a less sophisticated operator. Those do really well for us, because we can bring an additional level of professionalism into the management structure, which adds additional value beyond what we do from a physical standpoint. We look for disorganized management. We look for out-of-state owners that don't have their eyes on the property. We look for physical deficiencies such as dated units. My favorite one is like a mid-1980s deal where you walk in the front door and it looks like you're back in the 80s again. That's what we want it to look like, because we're going to make it look modern. When there's deficiencies around the outside, overgrown landscaping, all of those things spell opportunity. The other thing that we look for is, where are the rents today versus where the market is? So what are the comps doing? What are renovated comps doing? And what are unrenovated comps doing? And ideally, we want to see a property where the in-place rent is less than unrenovated competitive set. And then what our target is we want to end just underneath what the renovated competitive set is currently achieving, so that we have kind of a pricing advantage over the competition.
But at this time, we've been getting some deals from brokers, and I find, to be honest, everything is super expensive, and cap rates are on getting really compressed. But when we look at their projections, it's kind of funny, because they keep going like the rents will be able to increase them like in 10 years projections, and I don't believe that's accurate information. Would you agree?
Yeah, I would. I mean, you'll see all kinds of overzealous projections from brokers, from sellers. Our job as apartment buyers is to sort all of that out and find out what's real and what's just make believe, right? So we're looking at things like the immediate comp set. What rents are they achieving? We're looking at sales comps and where things are trading, but most importantly, no measure moves the needle more than the rent that we can expect to achieve after we've renovated a property. That right there sets the bar for everything else that falls into place. All the rest of it is a mathematical equation. If we can set the correct rent, we can work out all the rest of it.
But are you guys at this time, are you buyers, or you are like have a lot of dry powder and just waiting for opportunity to reveal itself?
Yeah, we are buyers. We just closed on a property 2 weeks ago, 198 units in Atlanta. We're closing on 232 units in Florida in 2 weeks. And we're actively looking for the next one after that. So we're absolutely buyers. To your point, you're right, cap rates have been compressing. But what a lot of people, they tend to overemphasize cap rate. And, cap rate has really only one purpose in underwriting multifamily property, and that is to figure out what your exit price is going to be the year you expect to exit. If you can anticipate what that cap rate is going to be 3, 5, 7, or 10 years into the future, and use that cap rate to predict what you should be able to sell your property for, that's the only thing that cap rate is useful for. All the rest of it comes down to what return do you need to generate to your investors for your investors to want to invest in the deal. And so now what you do is you got your future rent, and you reverse engineer the financials to the point where you've gotten that return that you need to achieve, and that will result in a purchase price that's going to allow you to achieve that. And if you can't achieve it at the asking price, it's not a deal. So yes, there's a lot of stuff that's really high priced, but that doesn't mean that that's what you're going to buy it for.
Gotcha. Regarding raising capital, what advice would you give yourself if you were starting out again to raise capital from the lessons that you have learned so far?
Raising capital, I really underestimated how difficult raising capital would be. Especially early on in the process. We think, or at least we'd like to think, to raise capital, all you have to do is find a great deal. And if you find a great deal, people will be attracted to it and want to invest in it, and the investors will come to you. Well, the truth is that's hogwash. It doesn't work that way. People invest with you because they trust what you're telling them. They trust that you did your homework. They trust that you're going to be able to do what you say you can do. So the most important thing that you can do when you're starting out raising capital is to show that they can trust you with all of those things. You've got to do your homework, and you got to be able to show them that you did your homework, and you got to be able to prove with third-party verification that your homework is accurate. You want to show them that you can execute the business plan by showing them a track record. Show them what you've done. And people say, well, how do I show what I've done if this is my first deal? And, the reality is, if you need to raise a lot of money for your first deal, it's probably too big of a deal for you. Start with a smaller deal, even if it's a single family home. Go out and buy a single family home, fix it up and resell it so you can show the next guy what you did. Then you can buy a bigger home and do that. And then you can do a duplex and show somebody what you did there. And then you can buy a fourplex and say, I took the rents from 700 to 900 in 18 months, and I bought it for this and sold it for that. And then they do the next deal and so on. I mean, that's how this is done. People want to look for shortcuts like, I've never done a deal. How do I go raise $10 million? Well, the reality is you don't. I've been at this for 28 years now. And literally the first 8 years I did this, I don't think we raised any money. After that, we raised about 3 or 4 or 5 million. And just in the last, 2 or 3 years alone, we've raised over $50 million. In fact, we've raised over $25 million in the last 60 days. And that's only done by showing a track record and showing that you've done your homework and showing people that there's a good reason why they should trust you with their hard-earned money.
Brian, I'm based in Europe, and what I see here, it just doesn't make any sense from a real estate investment, because it's basically all appreciation, because everything is super expensive and doesn't make sense like it does in the US. So all my focus and the focus of this channel and instructing these listeners is to get them to invest in the US. Having said that, what I would like to know is, people that are starting out, how would you advise them to start investing in the US if they are like overseas on some other places? How would you do it?
Okay, that's a great question. So, in fact, this is a very relevant question because, I'm based in the San Francisco Bay Area. So much like where you're based, we suffer from the same disease where our property is so expensive here. Everyone's banking solely on appreciation because there's just no real cash flow at today's pricing. So we have the same thing. So I get what you're saying. And that's why we buy very little property close to where I am. So most of the properties that we're buying, you know, I'm here in Northern California. Most of the stuff we're buying is in Texas, Georgia, Florida, Arizona, the Carolinas. You know, we're in markets that are, you know, far away from where we're physically located. So it's not the easiest way to run a real estate business, right? I mean, especially when you're just getting started. So when I first started in this business, the market was much different here in the Bay Area, and I was able to start right here in my own backyard. So, you know, now if you're trying to start out and you can't start out in your own backyard, you got two choices. You can either move your backyard and you physically go where you can actually do this business and oversee it personally, or you have to partner with someone or create a team in the area where you're going to do your investing. A good example is when I was not just starting out, but, you know, kind of not long after I had started, I wanted to go a couple counties away. Well, I had a friend that lived in that county, and I said, you know, I want you to, you know, go to the auction for me and drive by the houses and take pictures and send them to me, and, you know, and knock on the door and do all these things that I can't do because I'm not there. 15 years later, she's still doing that for me in that county, and we bought a lot of deals there. But you need that physical presence in some way. So, you know, you can either, you know, move to the U.S., come to the U.S., or invest capital in, in an operator that's here, or partner with somebody that's here, so that they can execute, you know, the plan from a tactical perspective, and you can, you know, get a return on your capital, from afar. For those who don't have capital and wanted to sweat equity, it's really, really tough. You know, you literally would have to have a partner here on the ground, you know, that you're in communication with multiple times a day.
Okay, so regarding for the future, where you see yourself and your company heading, since you pretty much have everything in control, what's next for you now?
Mm-hmm. Well, next for us, we just expanded our footprint geographically to a much larger portion of the U.S. We used to invest primarily only in Texas, and now we've grown our geographical boundaries considerably over the recent past. So what I see for us, over the coming, call it, 3 to 5 years, we're looking to acquire around 10,000 units of multifamily property in, geographically diverse markets of the U.S. where there's a real growth story, and implement a value add strategy on those assets. That's our kind of 5-year plan.
And going back, if you had to give an advice to your younger self, what would you say that will allow you to make a better decision regarding getting to where you are today?
I would say the advice is it's not as easy as you think it's going to be. Put your seatbelt on, because it's going to be a rough ride. Be ready for the ups and the downs, and there will be downs. But get going and really dedicate your time to it and just make it happen. The sooner you can establish relationships with capital partners, the better. The sooner that you can establish a track record and document that track record, the better. Those are the lessons I learned. I got a really slow start. It was from the time I made my first investment to the time that I was making substantial income from this business was over 10 years. And I think it could be done faster than that with a little bit more focus.
Gotcha. Regarding books, because I'm a bookworm and I like to share my book lists with just about everyone that I meet. What have you been reading lately, or some of the books that you like to share with our listeners? Whatever the type of the books may be.
Well, it's funny. I have very little time for books, so I don't read many. I can say that I'm in the middle of a book right now, which is called The Deal Maker's Guide to Commercial Real Estate by Ray Alcorn. It's like a $500 book, by the way, but it's 600 pages dedicated to commercial real estate. The information in it is very, very good. I found that, most of this is stuff that I've already learned through trial and error, and a lot of time on the ground and the school of hard knocks, so to speak, but the information in the book is really good. So that's the one I'm working on right now. I'll finish that one pretty soon. The next book that I have up in line, I can't remember what the title of it is, but it was written by a Navy SEAL, and it's all about, perseverance and going out and making it happen. And I'll have to research that and remember what it is, but it was recommended to me by somebody else, and it sounded really, really interesting.
Oh, regarding other interests, what do you like to do besides real estate?
Well, real estate really is what I do almost from the time I wake up until the time I go to sleep. But if I'm not doing real estate, I like to fly airplanes. I got my pilot's license when I was in high school, and I've been flying airplanes ever since. I started flying helicopters a few years ago and working on that. So I just love aviation and getting off the ground and looking at the world from a different perspective.
And finally, where can our listeners get a hold of you if they have any further questions?
The best way to find me is through our website, which is praxcap.com, and that's spelled P as in Paul, RAXCAP.com, short for Praxis Capital.
Brian, it was wonderful having you with us today. Thank you for joining us, and hope to speak with you soon.
Thank you. Thanks for having me on. It was a real honor. Thank you.
Okay, welcome.